Silicon Valley Bank collapse and bond investing. This is Ken Boyd. Well, the financial system collapsed almost. The week of March 11th to 12th, that weekend in 23 will be remembered as a moment of real terror for thousands of Silicon Valley Bank customers. We'll call it SVB here. Fortunately, the federal government stepped in to take over the bank and to guarantee access to all customer deposits. And so you may have heard a lot in the media about a run on the bank. So let's define that. Panic spread like wildfire before the weekend, leading to a run on the bank, a huge number of depositors trying to withdraw money within a few days. That's a bank run. If you've seen Frank Capra's film classic, It's a Wonderful Life, it includes a bank run on the building and loan. Now, customer deposits are a bank liability, and depositors can withdraw money at any time, generally speaking. During the SVB bank run, the bank had to liquidate assets to pay for customer liquidations, and that's where the problems began. Selling assets to pay depositors. So think about this. If you were going to pay $15,000 for a down deposit on a house in 3 months, where would you keep that money? Well, you need an investment that allowed you to access the cash right away without fees and penalties, without much expense. So you'd probably just hold cash, which makes sense. But there's two tricky things about banking. If you're a banker, you have to forecast the dollar amount of deposit withdrawals each month and how you will fund those withdrawals. And at the same time, you have to figure out a way to earn a return on those deposits while you have them. So let's go back to that home deposit. Why wouldn't you buy common stock with the money? Well, the price of the common stock can change quite a bit over 3 months. Okay. How about buying bonds, say treasury or mortgage-backed securities that carry a AAA rating, which is the highest credit rating? That sounds safer, but don't those investments change in price also? Yes, they do. And to understand why, we need to think about bond prices and bond yields. So let's assume that IBM issues a AA rated $5,000 6% corporate bond at par or $5,000. And each year the investor gets 6% on $5,000 or $300. That $300 payment never changes because of the $5,000 face amount never changes. However, what if interest rates increase? This is exactly what happened in the months before SVB, hard to say, had to sell bonds to pay depositors. If a comparable corporate bond with the same credit rating can be issued at 8%, a 6% bond would decline in value. Why? Because investors can get a new bond at 8%. As a result, the $5,000 IBM 6% bond might be worth only $4,800. And it's a big problem if the owner is forced to sell the bond when the bond's price is down. This is exactly what happened at the bank. So the bank received a flood of deposits from venture capital investors and startup companies that are funded by those VC companies. What did the bank have to do with the money? Well, Forbes explains that, quote, management took excessive risks by buying billions of dollars of mortgage-backed securities and treasury bonds when interest rates were low. And as we've seen recently, the Fed continually raised rates to fight inflation, leading to higher rates on treasuries. The value of those bonds declined in value. So the bank had to sell them at a loss, and the losses got bigger as more depositors requested funds. It was a spiral. More requests for funds, you'd sell more bonds, more losses. And it says, again from Forbes, the assets quadrupled in 5 years to $209 billion, making that bank the 16th largest in the country. So flood of money, they put it in bonds. Bond prices decline. When interest rates go up, they have to sell the bonds at a loss. And while it's difficult to predict the amount of customer withdrawals, buying long-term bonds when the money might be needed to pay depositors is a bad idea. That's sort of the lesson here. And for other great information on accounting and finance, you can go to my Substack, Accounting Accidentally, at substack.com. Thanks.